Hello, everyone, and welcome back to another MRMIA broadcast. I am your host, Marc Leprince, and you guys are listening to the Model Risk Managers International Association broadcast. And today we're kicking off a new series called the Credit Scoring Series. I have here with me Raymond and Pravin, and together we're going to discuss a range of topics from the impact of a crisis, the topic of today, as well as discussing shock periods, benchmarking, even overlays, as well as other topics in the future. So to introduce our guest today, we have Raymond Anderson. You may recognize him. He's been a guest on the show before. He comes with over 25 years of experience in the credit risk and credit rating model development, and is author of two books, The Credit Scoring Toolkit and Credit Intelligence and Modeling, which is soon to be published. He spent 34 years with Standard Bank of South Africa, and for the last 6 years has consulted with the IFC, the International Finance Corporation, in a variety of continents, including Europe, the Middle East, Africa, and Asia. Our second guest is Pravin Burra. He is CEO of Analytix Engine, a boutique credit and machine learning modeling consultancy, and has over 20 years of experience credit modeling, performing credit modeling, and in model risk management. He previously was a partner at Deloitte South Africa, performing model validations with a focus on credit impairment models, and also has an FRM from GARP. So welcome, everyone.
Thank you, Marc.
Thank you, Marc.
So to dive into today's topic, we're going to discuss the impact of a crisis. And I can't think of a better example than the one we're in right now, which is the COVID-19 pandemic. This has affected the world for over a year now. And during that time, governments have made significant changes to their policies, from affecting from the aid that they've given their citizens to for new rules around forbearance. All of those have kind of changed the definitions of delinquency. Likewise, these significant impacts have affected macroeconomic variables like GDP and unemployment rate drastically and swiftly. And in the face of these changes, the consumers have also changed their behaviors as well, moving from in-store to online shopping and moving from services to products. And in the face of such drastic changes in the markets in the world, this obviously will lead to changes in how institutions lend credit. And as we all know, the way that institutions decide to provide credit to their clients can become very critical to the future health of these institutions. So, Pravin, I'll start with you. Given that we're still in a pandemic today, what are some of the ways that model risk managers and modelers should think about these crises?
Thank you, Marc, and hello, everyone. I like to start at the beginning. And if we look at modeling and the assumptions fundamentally underlying modeling, they typically start with an assumption that the past is a good guide to the future. We look at past behavior, past outcomes, we model them, we generalize them, we test them, we apply them in a model in practice to make decisions in the future. And all of that holds through the long run, across the economic cycle. That makes sense. What we've seen following the 2007-2008 mortgage crisis, more recently COVID in the whole of 2020, which was, I think I'm at a loss for words to actually describe what it felt like. It's actually interesting. What we're seeing is that we have a lot of shocks. Those two specific shocks way beyond most people's expectations. But what we also see, if we look to the, for example, the VIX index, which measures volatility on the stock markets, we see that the frequency of shocks is much more common. And we see that the severity of shocks, COVID being an extreme example, But even if we look to one size smaller shocks, we see that they're becoming much more severe and much more common. So then the question goes, when does our model work? When does our model not work? And what do we do in those brief, hopefully, periods of time when our model performance may be negatively impacted by the shocks that we find ourselves in? And for me, I'd like us to think separately between a shock and a crisis. Shocks are common. Hopefully, crises are not. And in my own definition, the difference is how well you cope. So if you build a good risk management coping mechanism, and if you are able to manage, that is a shock. But if you end up in a situation where your entire infrastructure and results are beyond your control, then you're in a crisis. And I think as we go through today's discussion, I think what we want to understand is, given the increasing frequency and severity of shocks, how do we prevent them from being a crisis? And on occasion, when we don't have the control, when we do find ourselves in a crisis, how do we react? And we should never waste a good crisis, right? So we find ourselves in one now, so there's no time better than the present to revisit our infrastructure, to revisit how we think about our use of models, so that we can firstly address the current circumstances we find ourselves in, but then also better position ourselves for future shocks, so that we not only manage, but we outperform our peers. And so I would suggest we need to start by going back to first principles and thinking about, again, what do we do when the past is not a good guide to the future?
Yes, and that's a great segue to kind of my next question here is, so Raymond, when the past isn't a good predictor of the future anymore, how are models impacted? What happens to models during a crisis?
A comment that was made was never waste a good crisis. I watched a presentation by Edward Altman of Altman's Z-score fame, who said every time that there was a corporate default, he had a glass of wine. And in times of a crisis, you got lots of defaults, and that could be lots of glasses of wine. I don't quite know what his level of sobriety is at the moment, but I could well imagine that he's enjoying a tipple. My experience is mostly with credit scoring models, and sort of most of our focus is going to be upon sort of the ranking ability. And typically that is going to be impacted, but what really gets impacted is the overall level of risk that's affecting the entire portfolio. So the whole thing gets shifted up or down, and it probably applies to practically any model that you're talking about. The things will vary depending upon the level of the impact is going to vary depending on the source of the crisis. If you're talking about, I think the worst is internal or international conflict, in particular Spanish Civil War, World War II, World War I, wherever you have conflict, that is where one really has problems, and it's going to affect the AAA companies. Other types of crises, the impacts aren't going to be as bad, whether it be sort of the economic or the other areas, natural disaster. In some instances, it's short-lived. In other instances, it's going to carry on for a hell of a long time. Right, and everyone is going to be different. It's interesting, if you go back, the tech bubble, when it burst, sort of 1999 thereabouts, that was actually something that affected companies for quite a long time, about 4 years. If you look at sort of the defaults that occurred, or they were very spread out. This one right now, interestingly, looking at the market's got hit a hell of a lot worse by the crisis of 2008 and 2009. They've rebounded, but the impact upon different sectors is just so varied. And a big part of it is, watching the environment. I'm saying sort of you're looking at the models, yeah, but sort of it takes a while for things to start showing through with the models. You have to watch the environment and know that even if it doesn't reflect in your models yet, oh my, we have to worry. So ultimately, it's one has to sort of know a shock is possible. There are different types of shocks. Depending upon what shock is occurring, based upon what's happened in the past, you might be able to have some idea of how to work. Unfortunately, with COVID-19, the sort of last time was that anything so great happened was 1918, 1718 with Spanish flu. We have no data from then, so that affected our grandparents or great-grandparents, and they didn't talk about it. So at least my grandparents never spoke about it. I don't know if they got it, but they probably did. And they survived. Otherwise, I wouldn't be here. But in terms of the preparation, one really needs to know what models are being used. One wants to try to assess the sort of risks associated with the models, like how material is the model. Some models aren't going to have any impact. I'm talking about the entirety of the organization. I'm talking about in human resources and accounting and trading desks and everything. And where are the interlinkages? Now, when you're talking across the different domains, there's probably not a lot of interlinkages. But if you get into the PD, EAD, LGD, of course, those are all heavily interlinked. And just, what are they sensitive to? I must admit that I've never done sensitivity analyses, but sort of it is something that's very important.
Right. So to kind of summarize here, there's a variety of different kinds of things that can create a crisis, from international wars, economic shocks, what have you. And even though those can impact things such as markets very quickly, it may take a while before the data starts to show these kinds of impacts and make its way into models, changing their judgments. And so you always need to keep track of this, and making sure that you're keeping an eye on the markets, as well as paying attention to the models used, their associated materiality, linkages within the bank, as well as other sensitivities. So
I think there was something else here that's happened which should be mentioned, and that is that with COVID-19, in the United States, the CARES Act and a lot of other countries had sort of similar type things, where you tried not to impact upon the credit histories of people by and allowed for deferred payments, and so a lot of your reporting sort of got knocked out of kilter. And people were also slow to, how do you actually do it? Where one has to sort of, a lot of effort has gone into greater preparation to look after the customers ahead of time, not just the models, but also those people that you are having to answer to, not just your board, but also the man in the street who's buying your goods and services.
that's right. And so, Pravin, I'll kind of point this question towards you. So given these kinds of points that Raymond has discussed, and kind of some of the unique impacts that COVID has had, what comes out as the most relevant for credit scoring models, as opposed to other types of models?
Thanks. And I think before I go into that detail, I think just to reiterate something that Raymond said, and that you have to watch the environment. The model doesn't exist in a vacuum. So while we'll talk through the impacts on the model, the point he makes about watching the environment is critical. And I think that we must never lose sight of that. But at the end of the day, we have to manage our models and we have to manage our businesses. So let's focus a little bit on what are the things that happen and what are the things that we need to do about the things that happen. So if we look at credit scoring models specifically, and in a crisis or a shock, depending on its severity and our ability to cope, there's a couple of fundamental things that change. The first one, which often changes, is the change in the mix of business coming into our company or our organization. You might find a channel mix, you might find an industry change, you might find a change in mix of customers or a change in mix of the way customers use your products. You might find certain customers wanting to access a lot more credit with less collateral, for example, or other customers wanting to access less credit because they want to protect themselves from any pending shock, both of which have opposite impacts on the performance of your book. If customers pull back their borrowing, it negatively impacts your volume. If the wrong customers borrow too much, then it affects your credit loss ratio. But fundamentally, one of the first signs that something fundamentally is changing is the change in mix of business that you're writing. The second thing that often changes with that change in mix is a change in quality. So you might find customers with different credit scores wanting to borrow, or customers wanting to increase the terms of their borrowing, or the bullet payments in the case of motor finance, for example. Or customers wanting a longer period of borrowing so that the installment is smaller. So what you would find is the quality of business that's coming through the door might change fundamentally. And again, what's important here is that you look not just in your response as a blanket tightening of the screws on lending, but you need to be able to understand where is good quality coming from still, where is poor quality coming from, so that you can actually adjust your risk appetite at a more granular level. The third thing that's likely to change is the circumstance, and it's both your circumstance as a lender and your customer's circumstance. And again, Raymond spoke about remembering that there is an actual person on the other side. And your customer's circumstances might change a lot. And for example, if I give you a simple example, during bird flu, you might find people who are affected in the poultry industry, for example, might be adversely affected from a risk perspective. During COVID, we see opposite impacts on people in the tourism industry versus people in groceries and delivery industries, for example. So what you'd find is the circumstances of both yourself as a lender, because your ability of your staff to be at work approving loans and collecting on loans, versus your customer circumstances, depending on the industry and the geography they find themselves in, are fundamentally different. So those are the things that we see on the input side that change. And the easiest way to monitor that is to have good population stability measures in place and to have triggers when the mix or quality or average values and outlying values of the business coming in changes materially. So simple things like population stability with thresholds and triggers could flag these automatically for your attention. Because remember, again, in a shock, you have less capacity to respond as an individual. The second thing then is, if those things are happening, what's the fundamental things that you need to do to be able to cope better? So we want to cope better. How do we cope better? The three important features I think that you need to have, and that you will find the winners at the end of it, because they always are winners. People who are able to gain market share to make better margin than their peers, even if they're under duress. Three fundamental things, particularly as it pertains to credit scoring models. The first one is the ability to rank customers. If you're able to recalibrate your scorecard, to add variables to your scorecard, to take out variables from your scorecard, to adjust the business overlay and on your scorecard, The people who have the ability to adjust their ranking fast will definitely have a competitive advantage over those that do not. The second thing is, even though your ability to rank may change, you also will have a fundamental, and often this could be per sector, or in the case of COVID across your entire portfolio, the level of risk in aggregate that could change. And then you need a risk appetite, right? Do you withdraw enough from the market that you lose market share and don't help your communities? Because fundamentally, banks do serve a social good. And what is your risk appetite? How much can you afford to lend to which segment so that you can actually help customers through this very difficult time? So being able to recalibrate your PDs, for example, to manage your level of risk, to look at the changing haircuts on the value of security so that you can adjust the premium that you charge customers and the level of collateral you want becomes very important. And finally, the most important one, I think, is the operational requirement. Are you able to execute? So for example, in COVID, a number of regulators allowed you to run forbearance type arrangements, allowed you to do a payment holiday or an adjustment to customers without negatively impairing their credit limit. But in order to do that in some geographies, you had to pre-agree it with the customer before the customer did it. Now, if you did not have the systems to handle the volume of communications to your customers, if you did not have up-to-date customer contact information, and you were not able to offer your customer the choice of opting in or opting out, then in those geographies, you had a high proportion of customers who by default defaulted. So very importantly, the last one is the ability to execute. The ability to execute an update of your ranking, an update of your risk management, an update of your internal reporting to adjust for these changes in circumstances. And very importantly, the ability to communicate with your customers and regulators. I think that's very important.
Absolutely. Absolutely. And I think one of the things that I always start to take away from many of these talks is just beginning to learn just how much of a team effort model risk really is. Because looking at a lot of these, keeping track of these mixes, performing monitoring so that when these changes are happening as the applicant pool starts to change, see if there's any effect on the output. You're talking scores of people, let alone the underlying systems that you rely on to communicate in and out with clients and customers and everything else. So Raymond, Pravin, any kind of last thoughts here before we close out?
I think we've pretty well said everything. That's all, folks.
Excellent. All right. Well, to our listeners out there, tune in next time on another episode of the MRMIA broadcast. And we hope to have another series out for the credit scoring series out soon.
Thank you, Mark. Take care, everyone.
Yeah.
Thanks, Mark.